My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. I've been with my friends. I'm just trying to help you save some money here. My job is not just to teach, but also to entertain and to educate. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. All right, look, the Fed is in full rate hike mode. And it's scaring everyone, causing them to flee from the market as though they're trapped inside a burning building, which is why the Dow lost 282 points today. S&P tumbled 1.1% and 1.11%, and the Nasdaq dropped 0.97%. First time it hasn't been worse than the S&P in a while. Although, and that, by the way, that was a nice increase from where it was earlier in the day. Yeah, it was that bad today. There's just one problem with the thesis. Why the heck didn't these people sell at literally any point in the past year? Why now? Because here's what I think. See, I think the Fed wants to see lots of layoffs to tamp down inflation, and it's not happening. And they're getting scared. There's a shocking lack of urgency in actual corporate America. Like, most companies believe they can avoid a downturn even as their competitors get hurt. They think they're going to get through unscathed. Jay Powell can't fire anyone directly, but if you listen to him the other day, he's practically screaming at business people to stop hiring people. That's how you create slack in the labor market, which eventually translates into price cuts for just about everyone. The timing for all this negativity actually makes sense. I think we're going to see big layoffs right after Christmas because even Grinch-like CEOs have a heart, at least when it comes to timing. I mean, I don't know. They probably read Christmas Carol. The latest Fed statement gives every CEO in America cover to rationalize and let a lot of people go. The Fed's given you what you need to do. And that's why I want to start next week's game plan with the suggestion that we'll soon need to have a tote board for the layoffs because they're going to grow as business softens. I think the epicenter of the layoffs will be in Silicon Valley, with enterprise software being ground zero, software for big companies. Over the last decade, the hottest ticket in venture capital was creating these cloud software companies, most of which do exactly the same thing, whether it's analyzing data, protecting data, or connecting to data. These outfits could make a lot of money as long as there were new companies to digitize and migrate to the cloud. But eventually, you do run out of potential clients. We've hardly had any IPOs for the past year. And that means there are fewer clients, maybe far fewer potential clients, which means less business for the whole industry. So far, though, these enterprise software plays, again, I'm telling you, that's where the trouble is, have been reluctant to fire people. Maybe they are actually afraid of looking weak. I got news for them, bad news. They should be more afraid of their own viability, which brings me back to Jay Powell. In many ways, the most powerful tool in his arsenal isn't raising interest rates. It's the bully pulpit. He just needs to say he's going to keep raising rates. That's enough to deter businesses from hiring or encourage them to let people go. So when you see that Goldman Sachs plans to lay off a lot of people, no fixed number yet, but a lot, you got to figure the other brokerage houses will mimic Goldman and so forth. For instance, if you're in the used car business, you're probably going to mimic Carvana. If you're in retail, you might take your cue from Bed Bath & Beyond. Remember, Powell isn't the only one both talking tough and acting tough. His ally in Europe, Christine Lagarde, the president of the European Central Bank, said yesterday that they could be in store for 3 more 50 basis point rate hikes this year if inflation doesn't get under control. A major reason why the morning was so ugly, because we have to believe maybe it could head our way, too. I know it seems almost obscene to celebrate layoffs, but you need to understand the job losses are coming no matter what. The only question is whether they'll be small and surgical or more like the meat axe layoffs that we saw in 1980 when Paul Volcker broke the back of inflation with endless rate hikes, but also totally wrecked the economy. With that in mind, let's talk about what's coming. Now, we don't have much corporate news on Monday. It's kind of a strange day. It's just a void day. If I were a company, I'd report that day. It'd be the only company that anyone would focus on. But Tuesday's incredibly important. At 8:30 a.m., we get housing start data. And I have to tell you, this industry is usually the epicenter of the layoff destruction, not Silicon Valley. But not this time. We aren't building enough homes to meet our population growth, so housing prices just won't come down, which is a major disappointment from the Fed's perspective, because housing is a big part of inflation. That's another reason why Powell's targeting lower wages. Unless we get a big housing starts number, and I doubt we will, there won't be a decline in home prices, which is what he wants to see. So if Jay Powell wants to beat housing inflation, he can only do it by making potential home buyers feel too afraid to take out a more expensive mortgage, so a housing glut will develop. That could take years, though. We also get an earnings report from General Mills. I tell you, I like this company very much. The stock's up 29% for the year. General Mills was able to get away with multiple price increases because it's got the best brands, including pet food. The stock's up so much that I don't know how much it can still rally, even on a great number. But the market's getting oversold, and so therefore it could still work. The other side of the trade happens when we get after the close Federal Express. Now, FedEx has had a tough time of it. This company's prepared to take a ton of costs out, and because it's just got to get more profitable. Some people might be upset by the number, the size of the layoffs, if they do have layoffs. But let me tell you this: if you believe the Fed's playing a bad hand with a great bluffing strategy, you got my blessing to buy some FedEx after the quarter, because I think new management is going to make this company hum. Nike reports too, and I've never seen so many upgrades and price target hikes without anything behind them as we've had with Nike. Just like with Estee Lauder and Starbucks, two charitable trust names, it seems like people are simply trying to get into this one ahead of China's big reopening. And you know what? I think they're going to be right. I think Nike works. We know people aren't buying goods like they used to, but they're still traveling. So how about the cruise lines? We get results from Carnival on Wednesday, and I think they're going to be bullish because there are still people, plenty of people actually, who haven't gone anywhere in years, and they're desperate for a vacation. Cruising's a bargain, let's face it, and it should be one of the last groups to show pain as the economy slows down. You want to know how the small, medium-sized businesses are doing? Look no further than Cintas, which makes and cleans uniforms for these smaller operators. They totally dominate the market. If Cintas says business is better than ever, then we know that the Fed is not saber-rattling. They're raising. They're giving us some more 50s. After the close, we hear from Micron, the commodity chip maker. Right now, there's an immense glut of most semiconductors thanks to the worldwide slowdown and China's repeated lockdowns. Micron is one of the few companies that's been telling it straight the whole way, ever since 90. If they tell us there's still a glut on Wednesday, stocks in the low 50s, I expect, yes, just another leg down for the semis, even if they've been bouncing since October. I think that the most likely outcome will be a glut, and you'll see a lot of chip stocks for sale on Thursday. Now, Thursday morning, we get the best barometer of small, medium-sized business that there is, even better than Cintas. I'm talking about Paychex, payroll processor. They've got their finger on the pulse of this economy. Again, we want them to be downbeat. They're never downbeat, though. They've been having a good run, too. If Paychex talks about how their clients just keep growing and hiring and growing, then it means you got to be looking at some more 50s from the Fed. Just take it plain and simple. Same goes for CarMax, the used car chain. We used to hear that prices are being rolled back and sales are weak. Because that means the Fed's winning its war on inflation? I don't know. CarMax, troubled industry. Now, I feel terrible about all these negatives that need to happen. But if we don't get them, then the future looks even uglier because Fed will have to do a lot more than just talk. That's especially true if we get a core price deflator number on Friday morning that shows inflation still burning hot. This is a figure Jay Powell very much cares about. He seems to care about every figure, though. Here's the bottom line. We want the Fed to talk a big game without needing to actually do too much. Talk is better than action. We want him to scare the economy into slowing under its own weight. We don't want endless rate hikes or the 50 basis point Lagarde thing that we were talking about yesterday that will destroy everything in its path. I'm optimistic that Powell can jawbone us into much slower inflation. But after a day like today, I got to tell you something. I'm starting to feel like a pretty darn lonely optimist. Ken in Arizona. Ken.
Yes.
Ken, you're up.
Oh, well, good. Well, Jim, I just want to tell you how impressed I am that you and your staff can turn out these such high-quality, consistent programs day in and day out.
Wow.
Thank you so much.
I love that. I'm looking at my staff, and we are, but when Friday comes around, we're either like punch drunk or we're like saying, okay, this is the best show we're ever going to do in our whole lives. So I greatly appreciate the kindness of those words. How can I help?
Well, I want to talk about Dillard's today, DDS. They describe themselves by saying this is we are a retailer of fashion apparel, cosmetics, and home furnishings. And from there they go. They are about a $5 billion market cap, 6.2 total sales.
It is an inexpensive company. It's an inexpensive company that's doing better than others. I have to tell you, I'm not a huge fan of retail right now. We've really cut back on retail dramatically for our charitable trust, which you can follow along, by the way. Really, I thought, very good lecture yesterday that we gave, a little trade in our monthly meeting. I prefer Costco because I want to own the stocks of companies that create bargains for consumers. All right. I am actually still optimistic that Jay Powell can jawbone us into much lower inflation. But after a day like today, it's pretty clear I've got a very lonely position. On Mad Money tonight, this week was a nice reminder to make sure you hold a diversified portfolio that can handle whatever the market throws at it. So tonight we're playing MI Diversified, see if your portfolio can pass the test. Then we're wrapping up this week's series by taking a closer look at the top performing industrials of the year. I'm offering 3 names that I think could have a strong showing for 2023. Probably want to write them down. And should supply chain worries continue to be the top of mind going into the new year after all that we've seen? Let's find out. Let's talk to the CEO of Flexport. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.